Week 7, October 2nd. This is Professor Hasse of Business 330, our second to the last week of this course. And all of your assessed work is now posted to Blackboard. You're working on the second week of your capital budget analysis, which is due this Sunday, October 8th. You have in that to calculate the weighted average cost of capital, the net cash flow, and the investment return analysis, and then answer some questions concerning that analysis in a brief 1 to 2 page paper. That's what you're doing this week. Also, right now, the final examination has been posted to Blackboard. That is due October 15th, and we'll look at that in this week's Week 7 video. And we're also studying debt financing and dividends, topics of 2 videos we'll be looking at in this Week 7 lecture video. And then next week, we're concluding our class with a discussion of Chapter 18 and 19, long and short-term planning, which there are questions about those on your final examination. You'll be posting this final examination and then completing your work in this online business finance course. So let's take a look at our final examination and where we stand in this course heading into our second to last week. Okay, here's our Blackboard site. And if we go to take a look at where we stand in this course right now, in the second to last week, we have assignment number 4 is due this Sunday. The final examination, which is now posted in the final examination section of the assignments and examination of Blackboard. And then you'll complete that and post it by October 15th with no extensions. You can get an extension on assignment 4, but there can be no extensions on October 15th. That's when everything has to be posted. I will work on your grades that week. You have a course evaluation that I would like you to do. That link will probably be sent to you within the next week. That is due on Wednesday, the 18th of October, and then I will post all your final grades by Friday, October 20th. Now, I got a question this afternoon from one of our students in the class about he's already posted the assignment number 4, and does he have to wait a week to get that grade? And no, you do not. I'll be doing anybody who has posted their assignment 4 files already, I will be doing those grades tomorrow, Tuesday, and posting those grades so you have a good idea where you stand going into the final. And also, as you post during the week, I will update the Grade Center with those early postings of assignment 4, so everybody is aware of where you stand heading into your last 25% of the course. So hope that answers that question from earlier today. So again, right now we're in the final phase of our course assessment, and the final examination has now been posted. You are to post 2 files. You are to answer the questions and given, which we'll look at in just a minute. And also you are to update your financial portfolio as of October 13th. That Friday, the last Friday of our course, update your portfolio of that day and answer some questions involved in that. We'll take a look at that in a minute. And so you're to post your updated spreadsheet as of Friday, October 13th. Remember, the valuation of your portfolio and any gains or losses to determine from the very first week of your portfolio to the October 13th. So you have to update it over those 8 weeks. So here is the final examination. It's a combination of short answers, multiple choice, a little bit of internet research, signifying the main points of our course, especially from chapter 8 through 19. But I do ask some questions about the general definition of finance that we had throughout the course. So these short answer questions in part 1 are worth 25 points for these questions. Brief, short answer questions that you can either answer on the examination or put into a Word doc file to answer them. This Question number 9 would require maybe a little research for some of you. I would like the statement of sources and uses of cash from the following entries. In other words, somewhat like a statement of cash flow on the operations of a business. What is considered cash coming in? What is cash going out? And give me the net of all those cash coming in, cash going out, and what would be the net of those sources and uses. Then some true false questions. How about that? True false on the capital analysis project and capital analysis work that you've just completed with assignment number 4. Answer me true or false on these questions. And then some multiple choice questions on the last few chapters of our course, chapters 18 and 19, some calculations and some multiple choice questions in that regard. Each section is worth 25 points. So the final section is on your student portfolio. You are to conclude your portfolio on October 13th. Look up any dividends that have been paid on your stocks and put those in the dividend column. How many dividends per share? I don't want the total amount, but the per share dividends. If your company has declared a dividend from week 1 of our portfolio to the ending week of October 13th. What dividend per share has been paid by your company? Then calculate, like we've done in prior assignments, calculate the dollars and percent of gains or losses from what you started out with, the 100,000, to your portfolio value on October 13th. What has been the dollar amount gain or loss, and what is that in percentage? And then also find the Dow, the S&P 500, and the NASDAQ index on October 13th. And how has the Dow, the S&P 500, and NASDAQ changed from the very first week when we did this analysis in a percentage? And then that should help you answer the final question, did you better the markets? You should compare your percentage gains or losses to the percentage gains and losses of the market, and that'll give you a good indication of how your portfolio did versus the market. And that's what I want to see. So that all is in a spreadsheet file. You can do did you better your markets right on the examination sheet if you'd like. So that's the final examination. It covers all our material. It's a fair examination, but I would give yourself a couple hours to complete that in the next couple of weeks. So now let's take a look at the 2 sections of chapter 16 and 17 we need to be familiar with for this week. And I'll have some follow-up work on that in our Saturday video of this weekend for our weekend update video. But first of all, debt financing. What is capital structure and debt financing of a company? We have a clever little video to look at that. And then define and what is dividends, a very key component of returning investment return to stakeholders, to shareholders. Dividends. Let's take a look at a couple of videos that highlight the specifics and relate to our final examination of these 2 topics of week number 7.
Hi, my name is Paddy Hirsch. I'm a senior editor at Marketplace. And today I want to talk about capital structure. The reason being because it's integral to this whole issue of swapping debt for equity or preferred stock for common stock. In order to understand how all of that works, you need to have a good feel for how the capital structure of a company works. So we've shopped around for a little analogy that we could use to describe capital structure, and here's one that we came up with. So here is your average passenger airplane, okay? All right. Okay, it's kind of a wonky looking aircraft, but we can all recognize it by the wings and the tail and the fact that this is a slightly unusual aircraft because it's only got one exit door at the front here, okay? Only one door. Here's the ramp that comes out. And the aircraft is configured along the normal lines. At the front of the aircraft we have first class, then we've got business, then we've got this new thing that you'll see if you go on board the aircraft these days, in particular American Airlines, I can say with experience, which is it's like the Coach Plus. Okay, so we have Plus, and then after that, of course, we've got Coach. Everyone in the rear with the gear. Now, if this aircraft lands heavily on the ground or crashes, all right, because it's only got one door, it means there's a very specific exit routine for everybody. First class gets out first. Business class comes out next, then it's Coach Plus, and then Coach. Everybody's going to have to come out in that order. And that's kind of like what it's like for a company whenever a company collapses, okay, because these classes also equate to certain asset classes. So like first class are the loans, okay, business class are like the bonds, plus coach class is like preferred stock, okay, and then coach class is like common stock, okay. So why do these asset classes equate to these sort of classes on board the aircraft? Well, it's all about risk, okay? The further back in the plane that you sit, the more risk that you take, okay? Because if the plane crashes, then it's less likely that you're going to get out if because of the priority of exit. So say this plane crashes, the loan holders get out first, then the bond holders, then the preferred stockholders, then the common stockholders. And when they get out whole, that is to say, they get all their money back. Okay, so if we look at this, these delineations here, you see that they kind of fall into two. We have debt here, which is the loans and the bonds, and then you have equity. Okay, but preferred equity is slightly different because preferred equity looks like equity, but it's actually structured more like debt because there's this payment every month that the company has to make. So all of these issues here, these asset classes, loans, bonds, and preferred stock, these people all receive a payment every month. Okay, so now if we look at this debt and equity tranche, we can see that we can see what the company's leverage is, what its ratio of debt to equity is. So say in this case we have an equity ratio, a debt to equity ratio of 6 to 1. Okay, it means that there's 6 times the amount of debt than there is to the amount of equity. Okay, now if a plane, even at those leverage ratios, a plane can sort of fly straight and level, no problems, as long as it's making enough money to service the debt. That's to say, to keep paying the loans, the interest rate on the loans and the bonds, and to keep paying the preferred shareholders. But what happens whenever the company starts making less money, say in a recession? Well, suddenly it starts to head towards the ground. In the case of Chrysler, it starts to go to, head towards a crash. So what happens? Well, you want to right the aircraft. And one of the ways to right it is to convert some of these issues, some of these asset classes into common stock. Okay, so you could ask the preferred stockholders, say, to convert to common stock. And what will that do? Well, it means that you don't have to pay so much every month because you don't have to pay these preferred shareholders. And maybe you go to the bondholders and you say, hey guys, would you mind converting your bonds to common stock? And if you did that, if you managed to convince them to do that, well, once again, you've reduced the amount of interest payment that you have to make every month. But it also reduces your leverage. So say, for example, these preferred guys and these bond guys, they all decided to convert to common stock. Well, what does that do? Well, it means that you've cut your leverage down. Your leverage is now down to, say, 2 to 1. Okay? It means you're flying much more steadily. It means you've got much more people in coach now. Okay, coach is much larger. Your equity is much larger in comparison to your debt, which means that you've rebalanced the aircraft and you're flying much more straight and level again. Okay, so what's the incentive of these people to convert their bonds or their preferred stock into common stock? Well, the incentive is that if you don't do that, there's a possibility that the plane could, or the company could founder, the company could hit the ground. And if the company does hit the ground, then we're talking about a liquidation or a bankruptcy and potentially a liquidation. And if there is a liquidation, well, you're going to have to be assessing the situation and saying to yourself, okay, if this plane is liquidated, how much likelihood is there that I'm going to get my money back? Because the people that are going to get their money back first are the guys in first class, the loan holders. Only when the loan holders are completely paid off are the bondholders going to get their money. And only when the bondholders are totally paid off is everybody else going to get their money. So if you're a bondholder, in this case, and you're thinking about converting to common stock, you're going to say to yourself, am I going to get my money back if we crash? Or is it better for me to try and rebalance the aircraft, take a haircut, a so-called haircut, that is to say, convert your bonds into equity, which is probably going to be worth less than the bonds are worth at this point, but with the thoughts that if the plane starts to pull up, if the company starts to improve, then your equity is going to be worth more further down the line. That's the decision that these people have to make, and that's the case that's made to them whenever the company or the restructuring managers or whatever it may be are trying to get people to convert from debt or from preferred stock into common stock in order to rebalance the balance sheet of the company, in order to rebalance the capital structure and make it more likely that the company will survive. Of course, the bondholders may decide, you know what, maybe we'll wait to see what happens if the plane steams into the ground. Maybe we'll wait to see how bad the crash is. Maybe we'll wait to see what the recovery potential of the company is and whether or not I can get paid out at the end. But let me tell you, on the way down, while the plane is heading down and they're making that decision, if they make the wrong decision and everything crashes, well, it's going to leave everybody, even the first class, the loan holders, everybody very badly needing a drink.
One reason investors buy stocks is for the dividend payment. When investors buy stock in a public company, they own a part of that company. Dividends are a portion of a company's profit that the company decides to share with stockholders. There are three types of dividends. Ordinary dividends. This is the most common. It's paid in cash and may be paid quarterly, semi-annually, or annually. Stock dividends. In some cases, companies who want to conserve their cash can pay their dividends as shares of stock. Special dividends. Companies who have a good quarter or year might declare an extra dividend of additional cash or stock beyond their current dividend. Investors seeking income typically buy more stable and profitable companies that pay a dividend. They tend to be more interested in the regular dividend payment than the growth of the stock's price. Also, when interest rates are low, investors may reallocate their funds into more productive assets like dividend-paying stocks. View a list of top dividend-yielding stocks or access easy-to-use tools to find stocks that pay dividends on your own at etrade.com.
Our session is on dividend policy, which is a specific aspect of the capital structure decision. We cover 5 main topics: choice of payout policy, types of payout, how dividends are determined in practice, payout controversy, which begins with the theoretical proposition that dividends are irrelevant to firm value, then moves to conditions wherein dividends can decrease firm value, and conditions wherein dividends can increase firm value. We close with the implications of taxes for the firm's dividend policy. Firms have a choice of dividend, or more broadly, cash payout policy. In making the choice, it's important to note that a dividend or other cash payout is a capital structure decision, because a dividend payment takes equity as well as cash out of the firm. Hence, a dividend payout increases the percentage of assets financed by debt. The criterion for the payout decision is the effect of the payout on the value of the firm to its owners. We need to ask the question, does a dividend payment increase or decrease the value of the firm to its owners? There are several types of payouts to owners that a firm can use. Perhaps the most common is the cash dividend, where the firm pays cash to its shareholders. Firms can pay a regular cash dividend, which occurs regularly, such as quarterly, or they can make a special cash dividend payment. They might do so if they have extra cash at the end of a year, for example. When firms make a cash dividend payment, the market value of equity, or the share price, declines proportionally to the amount of the cash dividend. A second type of payout is a stock dividend or stock split. Here the firm issues additional shares to shareholders. In general, stock dividends and stock splits, or share issues, have no effect on the market value of equity. But the share price declines proportionally to the number of shares issued. A third type of payout is a stock repurchase, wherein the firm buys back stock from the shareholders. When it does so, the stock that it buys back is held in the firm's treasury, and that stock is referred to as treasury shares. There are several means by which a firm can purchase stock from its shareholders. It can buy shares of stock on the market, on the secondary stock market. It can have a tender offer to its shareholders to buy stock at a particular price. It can hold a Dutch auction. The firm offers to purchase shares from its owners at an initial offer price. The price is then lowered until the target number of shares are sold back. Finally, the firm can have a private negotiation with a large shareholder or shareholders, wherein a price is agreed upon and the stock repurchase is effected. In a stock repurchase, the market value of outstanding equity declines as shares of stock are taken out of the hands of its owners and put into the treasury. However, because of the increase in the demand for the firm's stock in the stock market, a stock repurchase can increase share price and thereby firm value. Here's the distribution of types of payout over the past 20 plus years by U.S. corporations. The top of each bar indicates total earnings. The red portion indicates cash dividends. The blue portion shows stock repurchase. And the maize portion shows retained earnings. Cash dividends, as a percentage of earnings, have declined in the most recent period in favor of stock repurchases, which have become almost as common a means of paying out cash to shareholders as cash dividends. Before getting into normative dividend payout theories, or theories about how much a firm ought to pay out in dividends, let's look at the results of research presented in the BMA text on how managers approach the dividend decision in practice. This research was conducted by John Lintner using a structured interview approach with corporate managers. He was able to develop several broad conclusions they showed, rather than short-term, year-to-year targets. Second, managers focus more on dividend changes than on absolute levels. Second, managers focus more on dividend changes than on absolute dividend levels. Third, dividend changes follow shifts in long-run sustainable levels of earnings rather than short-run changes in earnings. Fourth, managers are reluctant to make dividend changes that might have to be reversed. And fifth, firms repurchase stock when they have accumulated a large amount of unwanted cash or wish to change their capital structure by replacing equity with debt. Now let's approach the dividend decision from a normative perspective. What should the firm's dividend policy be? We start with the theoretical proposition that dividend policy is irrelevant. This proposition rests on the existence of perfect capital markets, or markets with no transactions costs, no taxes, good information, and no other market imperfections. Under these conditions, investors can convert shares to cash and vice versa without paying taxes or transactions costs. Since investors do not need dividends to convert shares to cash, they will not be willing to pay higher prices for firms with higher dividend payouts. Because investors can convert shares to cash if they need cash and the firm pays no dividends, or investors can get rid of cash they don't need or want if the firm does pay dividends, dividend policy may have no impact on the value of the firm. While perfect capital markets imply the irrelevance of dividends, the existence of market imperfections can mean that dividends affect firm value. Dividends can increase value if there are costs associated with the transaction of buying and selling stock. The notion here is that there are natural clients for high dividend payout stocks. These clients want cash flow, and they want to avoid the transactions costs associated with selling shares to get cash. So they increase the price of the stock through their demand for a dividend-paying stock. In the absence of perfect information, dividends are sometimes viewed as providing signals or information to the market about the firm's growth prospects. Dividend increases send good news about cash flows and earnings, and dividend cuts send bad news. Because a high dividend payout policy will be costly to firms that do not have cash flow to support it, dividend increases signal a company's good fortune and its managers' confidence in the future cash flows. The presence of taxes as an important market imperfection can mean that dividends decrease firm value. Companies can convert dividends into capital gains by reducing dividend payout. If dividends are taxed more heavily than capital gains, tax-paying investors should welcome such a move and value the firm more favorably. In such a tax environment, the total cash flow retained by the firm and/or held by shareholders will be higher than if dividends are paid out and taxed. As a general rule, if capital gains are taxed at a lower rate than dividend income, which has typically been the case in, let's say, the last 100 years in our country, companies should pay the lowest dividend possible. Dividend policy should adjust to changes in the tax code. So in recent years, we've actually had a change in the tax code, which has resulted in a lowering of the tax on dividend payment, so that the tax on dividends is now not very much higher than the tax on capital gains. This reduction in the dividend tax rate has likely stimulated higher dividend payout than would have been the case in the absence of that tax reduction. Here's a public policy controversy. In the U.S., shareholders are taxed twice. Notice in the table here, let's say the firm has operating income of $100. Further, let's say that the firm has a corporate tax rate of 35%. So the firm pays $35 in corporate taxes, leaving an after-tax income of $65 that could be paid out as a dividend to the shareholders. Now, if the shareholders have a 15% tax rate on dividends, which is the case now in terms of tax law, they will pay $9.75 on their dividend payment, leaving a total cash to the shareholder of $55.25. So the argument made on one side of this policy debate is that shareholders are taxed twice, first because their firm is taxed, reducing the potential dividend payout, and second, because their dividends are taxed as well. This dual taxation of shareholders is viewed as incompatible with the tax treatment of earned income, which is taxed once, and even the tax treatment associated with other forms of firm ownership, such as partnerships and sole proprietorships, which again are also only taxed once. The counter argument is that corporations are separate entities from their owners. As such, corporations and their owners are afforded special advantages and protections not available to either individuals or other types of firms. Hence, it is not inappropriate to tax corporations separate from their owners.
Okay, there are 2 or 3 good videos explaining capital structure and debt financing and dividends and the challenges associated with allocating dividends, both tax challenges and corporate challenges as far as how much you can give away and keep as retained earnings. So 3 good videos that summarize our discussions of chapter 16 and 17. We'll look at further issues with this and some specific problems in our Saturday video. So remember, you're concluding and finishing up your capital budget analysis week. And if you have time, maybe start on a couple sections of the final examination. I'll be around for any questions that you may have. Enjoy your week, and we'll see you up at the end of our week, number 7. Adios.